Australia's living God is deaf, dumb and blind. Martin North, John Adams. In the interest of people, I reckon your title's done it again, John.
Well, we're gonna create some waves today in today's show. We're gonna engage in some blasphemy and talk about Australia's living God. I mean, God is supposed to be all-knowing, and we're supposed to obtain wisdom and spiritual guidance from God, and God is supposed to protect us. These are the things that I learned growing up as a Catholic in Australia, and obviously, you go to church to obtain the Word of God. And so, unfortunately, in the last couple of weeks, I have gone to hear the Word of God. And unfortunately, God and his representatives are not happy with me asking so many questions.
Yeah, so we should say that we're talking here about the economic God rather than the spiritual God, right? The all-powerful.
Well, I mean, here's the thing, Martin. Perhaps the RBA governor who we're talking about is maybe he sometimes thinks he is actually God. I'm not really sure because the way he's treated by the establishment is. Yes. I mean, he is the one person. And on a very serious note here, he is the one person in the entire federal government who is treated with the most respect. He gets the least scrutiny. No one presses him hard. In terms of tough questions, in terms of his public interviews or public speeches. And I've always been wondering, and former members of parliament have asked me the last couple of years, why is it that the RBA governor gets special treatment compared to any other public official or politician? And so there is this godlike construct around this individual. And so we're going to talk about what God knows and what God doesn't know, because I think the real big shock of today's show is, this RBA governor is engaging in the most rapidly aggressive tightening monetary policy campaign in the last maybe 30, 40 years, and he's impacting millions of lives across the country. And what I've found out is he doesn't really know what he's doing.
And I would say, just on the God thing, what I found really intriguing over the years is how all the economists parse his every word from his every statement, right? And it's like, that's what priests did, right? They sort of analysed every little word in the Holy Book and sort of tried to work out what it meant. It's the same psychology. I've never understood that either.
No. But I mean, the really interesting thing is, so since interest rates have started to go up, the RBA governor in particular a couple of weeks ago gave an interview with 730 Report, and he made a number of important claims about what they're doing, how do they understand the impact of what they're doing, how safe or how resilient are households to absorb these rising interest rates. And so with some of these claims, I thought to myself, well, I just want to sort of get to the essence of what is backing up some of these statements. And so I've been peppering the RBA with a number of emails, and you've been included in some of this correspondence. and the funny thing is, and we'll get to this in our conclusion of the show, is that the RBA in their last set of correspondence basically said, we're sick of your questions. Yep. But I've been hammering them, not only because here's the thing about it, you can ask the RBA questions, and in fairness, they are good at responding promptly to questions. But then they give these vague answers, high-level answers, and they say, no, I want the specifics. So give me the specifics of this and this and this, because that's how you know at a technical level whether they know what they're doing or not. And once you press them for very, very specific answers, they don't like that. But this is really important, because we're not talking about just textbook economics. We're talking about real people with seven-figure mortgages, and the ability of them to do their job is going to have tremendous lifelong implications for millions of people across the country.
Yeah, and John, I've been saying for some time that my own analysis and my own data sets seem to me to be telling things very different from what the RBA official story is, right? And I think what we'll discover as we go through today that, maybe there's a little bit of a hole in the emperor's clothes. Maybe it's not quite as perfect as godlike as you'd like to see.
Exactly. Now, what are the most critical aspects of understanding the impacts of rising interest rates in this environment? And what is this environment? We are talking about not just a bubble, it's a hyper bubble. I mean, even Alan Kohler on the ABC only in the last few weeks said this bubble rivals Japan 1989, and the Japanese bubble was one of the biggest in world history. And we're bigger than that today. So this is a hyper bubble with huge financial risks to not only individual households, but to the banks in terms of financial stability. So the key aspect of this, Martin, is the cash flow situation of households, which is specifically what you track.
Yep.
Because what you need to know is, as you put more financial pressure on households, can they pay the mortgage? Can they pay the other types of debt that they may have? Are they, how are they responding to changing economic circumstances? Because their change in behaviour will obviously have an impact around the property market in terms of what bills they're paying, in terms of consumption, whether it's discretionary, non-discretionary. All of these. So it's not just. So you want to know, in terms of what are they actually doing, you want to know their cash flow position, cash in, cash out, as you say, but you also want to be able to understand the changes in psychology in a dynamic, changing environment. And if you can't track those things in real time, then you don't understand, one, the impact of your decisions, but two, what are the right decisions to go forward to get the outcome that you want to achieve. And so what I've learnt and what I've been really pressing the RBA on is this issue of cash flow buffers, but also their ability to understand households at a disaggregated cash flow level across the country.
Yeah, and just on that, John, I've always had a consistent methodology in my approach, which is to look at money in, money out, because I know that households prioritize things differently when they get into difficulty, right? As we've said before, the mortgage tends to sort of bubble up to the top as to be one of the things they try to pay. But the other question is, what else do they have to deal with in terms of, prioritizing other things or not spending elsewhere? And what is the economic impact of that? So these things are very, very critical to understand. And I have always believed that the compass that the Reserve Bank was using was a bit wobbly at best.
Well, so it's interesting you should say that, because before we get into the RBA, in the last few weeks, you have been getting specific, harsh, aggressive criticism on social media by the former chief economist to Prime Minister Gillard when she was in power, Stephen Koukoulas, who's an economist, and he has his own shtick about a range of stuff. But he has been hammering you quite aggressively, potentially to the point of whether you want to take legal action in terms of defamation or not, because he's specifically mentioned your company and your approach to things. But he's also made some very extraordinary statements about the status of the Australian economy and the status of Australian households, which beggars belief. So we're just going to go quickly in there. So if we can go to slide 1. So slide 1 is one of Koukoulas' tweets from the 8th of June, and it says, quote, "Any media using DFA as a source of information on mortgage stress has the same credibility as those using Craig Kelly on the benefits to humans of ivermectin as a cure for COVID. It's flawed in the extreme. Ask for the source of the information and you'll know never to use it." Now, I mean, I have to say that's a very specific and direct attack about what you do and how you do it, and you've been doing it for a long time. So just so the audience is crystal clear about your data set and how you do it. So you don't collect the data.
No.
So you commission an independent polling survey company who collects the data on your behalf. You survey 1,000 households a week. So over the course of a calendar year, that's how you get your 52,000 households.
Yep.
And then basically, so you formulate the questions with the polling company. You test them to make sure that they are robust, and you get statistically robust answers. And then you get that data sent to you by the polling company, and then you feed that into a model, a mathematical model that you've constructed with a certain set of parameters and assumptions. And once that data goes through that model, that's how you come up with your graphs around mortgage stress, rental stress, financial stress. And so maybe there could be some questions about the model or the assumptions, but the data itself, you're not manufacturing that. That's coming from an independent third professional party that you pay.
Absolutely, yes. And we've actually got a mutual agreement not to disclose who that is, because they also do a lot of survey and polling for other financial organizations and produce their own material too. So they don't want to have direct connection with me. But my survey is part of an omnibus survey, right? So it has other stuff in it too, which is why DFA is never actually out there in the public, because I don't care about that. But the data source is consistent. It comes in and it's a 0.5% sample. It's optimized across Australia to recognize essentially the way that the population is developing. And that's the source of truth, as it were, with this. And we ask a bunch of questions about the household formation, the cash flow, money in, money out, and a bunch of other things too, and also some attitudinal stuff too. So it's qualitative and quantitative. And that's the base information I then model. And as you say, I then build a series of algorithms to do various things, including calculating financial stress and those things. But that's the way it works. And we've been doing it since 2001. So this is not new. And of course, a number of merchant banks, for example, JP Morgan and I, for 10 years, we collaborated together and we used to produce joint reports on the mortgage industry. So there are other organizations who've consistently used my data, been very happy with it. And of course, the media also quote the data quite often. So I actually think it could be data envy from Cuckoo List more than anything else.
Sure. So just so I'm clear, have you used the same polling company or survey company for the last 20 years, or have you changed the company that you've been using?
So we changed it once about 12 years ago.
12 years ago.
But it's consistent since then, yeah.
It's consistent. Okay, so when Kakula says, if you ask for the source, you will know never to use it. Now, you've just said on camera, which like for the sake of the audience, I did not know. You just said you have a legal agreement not to disclose who collects the information for you, but it's a professional company.
Yep.
So if I don't know and you're not at liberty to tell anyone who it is, how does Kukulis know? Because obviously Kukulis in this tweet is saying he knows, and if he knows, then you can't trust it. So what's the truth of this particular aspect?
Well, I have no idea where he's coming from or why he's saying. What I would say, though, I offended him some years ago because I refused to take his bet on the momentum in the housing market. You may remember that. And
yes.
In fact, Tony LaCantra over in Perth picked up the bet and lost the bet, right? And it's interesting that the day he made that statement was the same night as he and I both appeared on ABC Adelaide on the radio there, and he basically gave his spiel about, what's going on, everything's fine, and I came in directly after him and said, no, that's not what I'm seeing from my data. So I wonder whether he was reacting to the specific instance where he and I basically appeared on the same radio station on the same evening.
Could be. Well, so why don't we go on to slide 2, because here's where he lost me 100%. So here he says, quote, household financial stress has never been lower. Yep, you heard me. I trust RBA, APRA, the bank data for any assessment of household financial stress, and not some manufactured data from snail oil sales people looking for media attention. My 2 million at take. Now, the one thing you've just revealed, Martin, is that some of the data that the banks get, you're getting it from the same type of company. It's a
different set of questions, right?
Different set of questions,
yeah,
but it's the same outfit.
Correct.
It's the same outfit. So if you trust the banks and the banks are using third-party providers and you're using the same provider, well, his credibility has just been shot. But there's 2 key things here. The premise that financial household stress has never been lower. It is impossible that any rationally sane economist could sustain, because on any rational basis, that is just a flat out lie. Now, you could say that they don't believe that mortgage stress is at 43%, which is what your graph says. So someone could say, well, it's high, but not. And some other independent people have said it's 10, 20%. It's not 43%. But to say it's never been lower is just nonsense. But the other thing is the RBA's own data. If you, for example, anyone can go onto the RBA website, download. I think it's the table E2, which is looking at household ratios. Look at household debt to income. It's never been higher. So you look at these basic ratios that the RBA, with its own data set, publishes, and it's showing that there is something really wrong with household balance sheets in terms of debt relative to income. And this person says stress has never been lower. That is just impossible for Koukoulas to say. And I just don't understand. I mean, he's got like 55,000 Twitter followers, and he is regularly interviewed by the mainstream media. This guy is completely nuts and off his head.
Well, there is a point about definition on stress, right? So essentially, I define stress in a particular way, which is a cash flow measure. It's not a 30% of income going on the mortgage, right? Which is one way that many people have done it previously. And some of the other people who provide information on mortgage stress use that same definition, 30% or something, right? But the other point I'd make, John, is I'm speaking quite often to some of the financial counsellors across the country, right? And they've been saying to me in the last few months, they've never had so many inquiries about people in financial difficulty, households across the country, more people struggling with these large mortgage repayments and things, right? They've never seen it. So the other evidence that's out there is also indicating that there's a problem rather than there's no problem. And actually, if you look at some of the statistics that the RBA has come up with, they also have proved that there is actually some proportion of the household population that are in difficulty. The marginal borrowers, they are definitely in the round of the problem. I guess the only point is, if you look at it in aggregate, maybe the average isn't too bad, but the average masks completely the differences between the well-off, well-heeled, fine, and the rest of the households who are not. I think that's maybe part of the problem, but his statement just holds no water at all.
Absolutely. But even, Martin, if you just look at the aggregate, household debt to income has never been higher. So the aggregate measure is basically, again, the ABC, Alan Kohler saying we're in a Japanese hyper bubble in terms of debt. So but
you see, but debt and serviceability ain't quite the same, right? Because the argument is rates have never been so low. Right? Even now, rates are really, really low. That's the argument that's used. So that the argument is based on ability to pay the mortgage because the rates are really low. But that doesn't take account of the rest of the cost of living that are rising very, very strongly. And of course, the rates are going up.
Exactly. Now, if we go on to slide 3, so this is from the 14th of June. Koukoulas says, an absolute masterclass from RBA Governor Lowe on 7:30 report. Make sure you have a good look at the interview. Many home truths. Well, I will agree with the second half of the statement. I would encourage our viewers to go on YouTube and watch what the governor says, because I thought it was a very poor performance from the governor. I didn't think it was a masterclass at all.
Well, I agree. I have to say that I was sitting there thinking, well, that's very interesting. So at least he came on 7:30, I suppose. And the fact that he came on 7:30 in the first place is quite an interesting indication that he felt he needed to, right? Yeah. But actually, if you look at what he said, there were some interesting holes in what he said and some interesting tweaks that he made.
Well, yes. I mean, now I have no evidence of this, but can I say I think he went on 7:30 because the RBA has been smashed with correspondence from borrowers who said, I took out a mortgage specifically because you said no rate rise before 2024. And so he was pressed on that question. And obviously his answer was, well, you didn't hear the full statement. The full statement was, if the economy evolves with our expectations, and it didn't. That's why we're right, like in terms of raising rates. But obviously people don't pass the words of the God from Martin Place like we do, and they probably didn't pick up the nuance. And yet, unfortunately, and to be honest, if I can be completely honest, I spoke to a mainstream journalist today who's been writing about these matters, and this journalist is very concerned for the welfare of some of the Australians she talks to, because she says they have signed huge mortgages and they feel they have been misled, and now they are financially screwed because they listened to the governor's communication and they thought he was giving a pretty firm statement, and and now they feel both psychologically but also in terms of mathematically that the rug has literally been pulled from underneath them.
Yes, and of course there was a whole different context then, and rates were very low, and people expected rates to stay low, and the government at the time was saying great time to buy, etc., etc. But a lot of people, I think, quite rightly feel they've been completely shortchanged, and now rates are moving against them quite quickly. And in some cases, with very large mortgages, the step up in rates it's going to decimate them.
Absolutely. Now, there was a couple of other very interesting things that the governor said in this interview, and this is why I've been peppering the RBA with emails. But he was asked point blank by Lee Sales, do you look at the impact of your decisions on households? Response, we spend considerable amount of time looking at disaggregated household data. So once he said that, I wanted to know, well, what are you looking at? Because obviously Martin North, DFA, looks at disaggregated household data in real time. You're interviewing people week to week,
yep.
And you're getting new information basically in real time about what's happening on a week-to-week basis. Is he looking at that type of week-to-week real-time data or not? That's why I wanted to interrogate that. The other thing he talked about was that there was an increase in how. And here's the critical point. He said in extra savings. It wasn't just savings. He said an extra 250 billion of extra savings during the pandemic, and that was going to put households in good stead to manage the inflation as well as rising interest rates. And then he also said that in terms of trouble in servicing the mortgage actually declined during the pandemic. So these were three really interesting claims he made, and I thought to myself, well, Lee Sales really didn't press him on those points, and I thought, well, I want to press the RBA because I just want to get to the essence of do these statements have legitimacy? And in the course of the last couple of weeks, as I've been hammering the RBA with specific questions, the answers have been quite surprising.
Well, let me just make one other point, John. Through the pandemic, of course, APRA changed the rules and allowed the banks to declare loans in default, not in default effectively, because they postponed repayments, right? That's another reason why people effectively had the ability to save a little more. That, of course, has now been reversed. So I don't think necessarily you can just look at the one point of data. APRA made some really big changes to accommodate the banks through this cycle. And that's something now that's coming unwound again now because people are suddenly finding that they're having to make those repayments. So.
Yes. Now, in this issue of disaggregated data, because again, if the God from Martin Place gave a masterclass, if he is all knowing, if Martin North is a snail oil or snake oil salesman, what we need to and again, so households, people watching this show, if you are financially in a bad spot because of these rising interest rates, what you need to know is the RBA board, when they are sitting down month to month making these decisions on interest rates, do they understand you? Do they understand your financial position today and how that position is evolving in the months ahead? Because if they do not, they're flying blind, and they're going to make decisions on interest rates without the full knowledge of what the ramifications are. And so when I pressed them on, okay, how are you monitoring households? It came back in a couple of different ways. The first thing that the RBA said was they are tracking both wealth, but also cash flow on a cash flow basis. So they're looking at both. They're looking at, so they have a whole host of statistical series at the RBA, but also the Australian Bureau of Statistics, which look at a aggregated view of households across the economy. Now, aggregated data it gives an indication, but it doesn't actually give you a disaggregated view as to how many households are really struggling with a mortgage and how those people evolving as you're rising interest rates, which is the really critical part there. But the other thing is with some of this disaggregated data, it's at least 3 months old. So for example, when they first raised interest rates in May, what published publicly available data did they have at an aggregate level? The December quarter. And so not even the March quarter had not even been released yet. And so maybe they had some pre-publication data, particularly within the RBA, that they could have looked at. But in terms of things out of the ABS or potentially APRA, I mean, all of that was quite delayed. Now, when it comes to, again, this is the critical point, cash flow data. I said, what are you looking at? Now, they could have sources from the banks. The banks, say CBA, and I know you spoke about this in a recent show on DFA. CBA has a huge data team. They collect a lot of real-time information about mortgages, about credit card use, about patterns around consumption, and the CBA has a very good feel for what a good proportion of the Australian people are experiencing. It's not the complete picture, but they've got real-time data. Now, it's in theory that the RBA may have either direct or indirect information flows from the banks about are they seeing trends, patterns, problems, etc. But they didn't say that to me. They said they look at HILDA. Now the HILDA data, which comes from the University of Melbourne, and people can Google this themselves. So the annual 16th series was published last year in 2021, but the data was collected in 2020. So this HILDA data is direct survey of 17,000 Australians, and they asked them very specific questions about income, expenditure, household formation, cash flow situation, stress, etc. But it is 2 years old, and if you're making decisions in 2022, HILDA is completely redundant. But that's what they cited to me. And so late last week, I emailed them again and I pushed them on this answer. I said, well, noting that HILDA is 2020 data, what disaggregated household cash flow data are you looking at that was collected in 2022? As of today, Monday, I can say I have not received a response from the Church in Martin Place, and dare I say, I don't think they're going to be forthcoming with the real revelation that they don't know or they are unable to track this in real time, and that means if they can't track this in real time, they are flying blind.
And just to underscore that, John, 17,000 or so from HILDA, 2 years old, or 52,000 from my survey over the last year, updated monthly and weekly, right? Which is most accurate? Interesting question.
Exactly. Now, when it comes to this issue of this extra savings, now, it was very interesting because a week and a half ago, the RBA is on national TV saying the extra savings during the pandemic was $250 billion. Now, last week in a prepared speech, the RBA governor said, this was Tuesday last week, he said households have saved an additional saved more than 200 billion. So I'm thinking, okay, so it's 250 billion one week, then it's more than 200 billion. So why the different language? So I wanted to scrutinize it. And again, I said, so where does this number come from? The response is it comes from the national accounts, which is published by the Australian Bureau of Statistics. So in the national accounts, which is quarterly, they have some information about household income, household expenditure, and they're looking at what that difference is. But again, this national accounts data is aggregated for the entire economy, and so it doesn't tell you in this data set who has a mortgage, who doesn't have a mortgage, who is actually doing the saving, etc. So while it may give you a general national stylized idea, it's not so critical about financial stability, mortgage stress, and can people handle all of these sort of aspects. But so they come back to me with this general answer, and then I went back to them and said, okay, but given that you've got different language from week to week, it's 250 one week, then it's 200 billion the next week. I want the specific calculation because I remember when I was in high school and we'd have to give the answer like I did advanced mathematics. I mean, it wasn't just tell me the answer, show me how you got to the answer. And if you couldn't show how you got to the answer, it doesn't matter if you got the answer or not. You wouldn't actually get the marks in your exam. So you have to show. So I said, I want you to show the workings. Well, they didn't do that. They refused to give the workings. They came back to me and said, well, what they've done is they took an average of how much households were saving in 2018, 2019, and then they compare that to how much households were saving in 2020 and 2021, the years of the pandemic. And then they said that there was more savings in those 2 years compared to 18, 19, and that's how they worked out the difference. And so that's how they get this difference. But again, this is all households across the country. There is 250 billion. Now, what I can tell you from the APRA data, Martin, is that as of March 2022, that how much mortgage debt in terms of actual dollars, it's $2.33 trillion. That's how much households, in terms of all of its forms, has secured against property, including with self-managed super funds. So again, so you think to yourself, 250 billion. I mean that sounds like a big number. When you start to think of how much households are indebted to the tune of, and again, this is just mortgage debt. Yep. This is not credit card debt. Yep. This is not buy now, pay later, but just mortgage debt alone. $2.333 billion. That's a big number compared to this so-called $250 billion of extra savings.
And I think it's very interesting that 250 was quoted very religiously last year by the Treasurer at the time, well before the election campaign. And the fact that number is very rubbery at best, and it's not actually getting to align with particular types of households, just an aggregate number. And we also know from my surveys that about a third of households are doing really well. They've had significant growth in their property value, and they've had significant growth in their stocks and shares and other things, and their savings have gone up. So some of those could actually just be to do with the fact that the stock markets have been a lot higher until quite recently, right? That could be one of the sources of growth because it's part of the wealth.
Yes. And obviously, just so we can highlight for our audience, so you've said a third's doing really well.
Yep.
A third is basically stuffed with no buffer, and there's a third in the middle, and they are sliding towards having little to no buffer.
Correct. Exactly right. That's exactly what I'm seeing. So it is not equally distributed. And if you then actually overlay mortgages, right, on that distribution, what you discover is, again, there are some people with big mortgages that are doing fine, but again, there are lots in that middle area with mortgages that are pretty horrendous. But down in that bottom third, quite a few of them have big mortgages. And some of the more affluent households, you would expect to be, feeling it really well, they're down in that third area. They're actually in difficulty now. So one of the things I talk about is affluent stress. So we've got some quite rich people, quite well-off people in terms of property portfolios and things, but they're leveraged to the gills. And these small increments of interest rate now are really hitting them hard.
Well, look, I don't want to be too offensive, but when you say they are rich people, no, they are people pretending to be rich.
Yes.
But when the tide goes out, you're going to realize that they were trying to present a facade to society that didn't have any financial substance behind it.
So it's net and gross assets, right? So they might have lots of asset, but actually there's a lot of debt on the other side of the balance sheet. You net them off and they've got almost nothing. But you're right, they're actually people who give the impression, they drive around in smart cars and everything else. They give the impression of wealth, but the truth is very different.
Look, Martin, you just remind me of a story. I remember in the last couple of years, I was in Adelaide and I gave a presentation. Maybe this was in 2019. And one gentleman after one of my seminars came up and said to me that in the GFC, so before Lehman's went bust in September 2008, he had a share portfolio of $1.5 million and he had margin debt of $1.2 million. So his net equity was $300,000. But when the stock market collapsed, he basically got wiped out. So whether it's equities or whether it's property, if you have a small amount of equity and a huge amounts of debt, well, if asset prices changes, whether it's real estate prices or equity, or in terms of shares, your actual wealth could evaporate like that.
Correct. That's right. And some people, of course, have crypto, which, of course, has also dropped as well. So wherever you look, you start seeing these stress signs. And, the point I want to make, John, is that mortgage stress is not something that just lives in the western suburbs of Sydney, right? it is much more pervasive in more affluent areas too.
Yes. So what our audience should get from this dialogue, Martin, is that if you are making financial decisions based on communication from the RBA, you cannot trust it, because once you start to get into their information that they're looking at, it's not detailed enough for them to understand the impact of their decision. So it's either aggregated data, it's either data that it is out of date from a couple of years old, or in some of this stuff from the Australian Bureau of Statistics, it's not forward-looking. It's telling you about what has happened 2 or 3 months ago. And even if you're looking at data, say, from late last year or in the first quarter of this year, I mean, the economic environment has just dramatically changed in the last 8 weeks. And you need to understand what happens. So when the markets are very volatile and things move very quickly, you need to have a very good feeling as to how households are responding in this type of environment. So if you've got data from 3 months ago where things were more calmer, it doesn't give you a good feel for what policy should be going forward and how are people responding to whatever policy decisions you're making. And so that again, now, I would strongly encourage, if any of our viewers want to get more detailed information about what our decision makers are looking at, feel free to email the RBA. Feel free to ask them these types of questions about, what type of data you're looking at, how you're making your decisions, etc., and get into the specifics about their answers, because they'll come back with something vague and it sounds good on the surface, but then that's when you got to drill down and get a feel for how robust are these decisions, and they're not very robust. So I'm actually quite concerned that the RBA is going to miscalculate their monetary policy going forward, and potentially as I said in the last few shows, they're going to inflict pain. They're going to bankrupt a certain percentage of the population, and then they're going to realize the pain, they're causing too much damage, and then they're going to stop and pivot, and they're going to reverse. And so it could well be that they inflict too much pain before they realize that things are getting out of hand.
And John, I'll make one other point. Because things are moving very quickly, how are they going to get the up-to-date read on the impact of their policy changes before they make the next decision?
They can't.
Right. That's a big deal, isn't it?
Yes, absolutely. Particularly when you're making interest rate decisions, in terms of precisely.
Yep.
So they make a decision early May, early June, early July, and Westpac is expecting another rate rise going to happen in terms of August as well.
Yep.
So how do you know how households are responding week to week to week when you're basically making one of the largest interest rate adjustments in Australian history? They have no idea what the impact is, and that is frightening for households that have huge mortgages who are hoping that our decision makers are making good decisions in real time.
And I have to say, John, I'm still getting a lot of people who say to me, well, the government won't let this happen. The RBA knows what they're doing. Everything's fine. I'll just carry on as normal, right? I wish that were true, but I really can't believe that it is.
Precisely. So if anyone thinks that the RBA knows what they're doing, I mean, if they don't believe us, go email the RBA and send me or send you their correspondence, because I think if people scrutinise the RBA, they're going to find out what I've been finding for the last couple of weeks.
Yep.
But just moving on, Martin, the RBA governor over the weekend and late last week was in Zurich, meeting all the other central bank officials, potentially copying down notes as to what he should be saying and what he should be doing, given that he's highly influenced by his international colleagues. But he also gave this very interesting interview with the Financial Review, and so let's put slide 4 on the screen and talks. And so basically, the RBA is warning of Australia's shift in inflation psychology. So what he's saying in this article, Martin, is he's saying that there's a narrow path to us avoiding recession. Now, I think that's complete BS, to be honest. There is no narrow path. If you jack up rates too much, you're going to push the economy in recession because of this huge household debt bubble. And I should note, the Treasurer, Jim Chalmers, gave this ridiculous interview on Insiders yesterday where he's talking about labour productivity and wages growth, and not even any mention about household debt and financial pressure and all of this sort of stuff. So, if people thought that this new government was going to be a different type of government compared to Morrison and Frydenberg, Chalmers basically has shown himself to be a continuation of Frydenberg, and there's literally going to be no change in thinking in Canberra in terms of where we go forward. But just to go back to the RBA governor, I just found this highly interesting that the governor's basically saying that if people expect prices and wages to go up too high, I will have to raise interest rates more than what I'm planning to, and that will inflict more pain. So basically, if you've got to keep your demands in a reasonable level, otherwise I'm going to inflict more pain. And I'm just thinking to myself, well, hang on. I mean, look, this governor caused a problem, and because he's saying, if we go into recession, it's not me that got us into recession, it's you. Yep. So keep your demands in check. Don't be too greedy about wages. Don't be too greedy about prices or profits. And if you're humble, I will save you by going into recession. Rather than saying, I inflated the biggest bubble in Australian history, a hyper bubble that rivals Japan in 1989, and maybe I need to look at myself in the mirror. He's saying, if this all goes to custard, it's you, the Australian people, who is to blame, not me. I mean that is the mentality of a totalitarian leader that history is littered with, that ends up in terms of disaster. And without being without using the person's names, Burley in 1945. Look, I mean that sort of mentality rings true.
It is shocking, and where does accountability lie? Where should it lie? Well, the people who actually made the dumb decisions earlier are trying to deflect. That's what they're doing. They're deflecting. So look, absolutely no accountability in the system, no recognition of the scale of the problem. And obviously the RBA has its disciples and all of its chiefdoms out there basically trying to defend it on social media like Kukulos. And then it's basically saying, I'm not the problem, you're the problem. So, but then we go on to a specific quote from the article. So let's actually put slide 5 on the screen, Martin. And so here's the RBA governor quote: I think we can navigate that path, as in the path that avoids recession, but there are risks. The risk comes from the global economy in the uncertainty around how households are going to respond to high interest rates. And this, again, just underscores what we've been trying to say in the show. He is saying publicly, as we raise interest rates, me as the chief person around the RBA board, who basically dictates the agenda and dictates to the board what the bank wants to do. He says, I don't know how people are going to respond. I don't know how people are going to behave. And if he doesn't know, how can anyone else at the RBA how are they supposed to know? I.e., they can't. They're flying blind. You've got a much better handle as to how these changes are happening. But also, as you said earlier, financial counselling services are getting real people in real time with real financial troubles coming forward, and they're saying they've never seen it as bad as it is now. And he's just saying, I have no idea. So all he can do is raise interest rates and then try to rely on delayed data to give him a review vision idea as to what the impact was, and then they just have to try to guess based on the data as to what they should be doing going forward. So they're making decisions. They have no idea the impact. Whatever data they get is going to be 2-3 months out of date. And at some point they're going to realize they've caused too much pain, too much damage, and that's when they'll have to stop. But those people who get wiped out in the process, you're being led by people who are treated like gods, but it's like the Wizard of Oz. Once you pull back the curtain, there's not much there. Absolutely. And, as they passes day and as the rates go higher and the consequences flow through. And of course, the high inflation bears down on households. So this is a long-term problem, not just a short-term problem. What you find is that the quicksand is getting more and more soft, and more people are getting bogged down on it. Right? If he doesn't understand that, I have a major problem with him then.
Well, look, I've had a major problem with him for 2 or 3 years since we've been doing this show. So, so I was glad that you finally come to the party in terms of the RBA governor. But now I'll just finish off on this point. So if we're just going to be completely statistically accurate, Martin, it is true that for some households with a mortgage, the buffers have increased. Now, how do we know that? Because since March of 2019. APRA have changed their publicly available data set, and they do have some new information about mortgages, credit, and then in terms of what is money in terms of offset accounts. So we can put slide 6 on the screen, Martin. Now, one of the key things that our viewers need to understand is in this APRA data set, there's a difference between the credit limit, so how much credit do you have available to you versus the credit balance, how much do you actually owe? And so that real difference between the credit limit and the credit balance is basically prepayments or payments in advance in terms of the mortgage. So you may, for example, have a $500,000 mortgage. You may have paid in advance $50,000. So your credit balance would be $450,000. But if you wanted to redraw on the mortgage, you've got an extra $50,000 that takes you to your credit limit. Now, as I looked through this data over the weekend, what I found was that the difference between the credit limit and the credit balance increased by $38 billion from March 2019 to March 2022. So what that means is an extra $38 billion of extra payments has been paid on the mortgage. And so that is, a positive thing that there's been more advanced payments. But again, when it's $2,033 billion of total mortgage debt, $38 billion isn't that much. And again, this is an aggregated number. And so we don't know which households in particular have put on the extra $38 billion over the last couple of years in terms of additional repayments.
And one point there, John, some of that money came from the superannuation withdrawals that people were able to make through the COVID period. They were able to take money out of superannuation. What they did, took it out of super and paid down their mortgage, right? That's one of the things that I saw in my surveys. So they're robbing Peter to pay Paul.
Excellent. Yes. So that's obviously a decision that certain people have made. But to be honest, like obviously you want to try to build those buffers up. So using super for that purpose, to my mind, it does make financial sense in the circumstances. Okay, Martin, I want to now move on in terms of looking at in terms of these offset accounts, because a lot has been made about this in terms of the public square, and that some of this extra savings is money that have been placed in terms of offset accounts. So we do have some data from APRA around in terms of offset accounts. So if we put slide 7 on the screen, what we can find is that from March 2019 to March 2022, an extra $65.72 billion is sitting in terms of these offset accounts. Now, what I tried to do was I wanted to get a sense as to how does this offset account balance measure relative to people that owe money in terms of money on the mortgage. So what we can see is that the money in the offset account as a proportion of total mortgage debt in March 2019 was at 9.1%, and that grew to 11.2% in terms of March of this year. So the amount of money in the offset account on a relative basis to what people owe on the mortgage has grown over the last couple of years. So again, that is a positive sign. The problem with this is that, again, aggregated. We don't know which households have actually put extra money in terms of the offset account versus those who haven't. The other problem with this data is, Martin, is that the APRA data only goes back to March 2019. So we don't know what happens when you have high inflation. We don't know what happens when rates go up. And it's because what I suspect is going to happen is people are going to draw money down from the offset account to pay everyday bills. but also particularly if they're on variable interest and the interest and the mortgage repayment goes up, those additional extra repayments. So if it goes up, say an extra, a couple $100 per month, well, they're going to draw that extra money. If they don't have the extra income, they're going to take it from the offset account and they're going to use that to make these repayments. And so what I suspect is going to happen is that once we start to see the June quarter and the September quarter in terms of offset account data, dare I say, I think we're going to see those numbers lower. And then the question is, well, as they run lower, again, the critical decision around financial stability and for us to avoid what happened in Ireland is we need to understand what is happening in terms of specific households and how what that sort of buffer is. And so just like you said before, there's a whole bunch of people in the middle with some buffer, with some money in that offset account. But as we go forward, they're going to run down that buffer, and then they're going to be placed in a very difficult situation as to do they stick with the property, do they sell it? And obviously one of the interesting stories that came out last week was Nassim Kadem at the ABC, who profiled one borrower who is on a fixed mortgage now, and by January next year, her repayments could go up $20,000 a year, and that's based on today's rates. And potentially by September, as rates continue to go up, that additional repayment next year could be $30,000 or $35,000, and so those people are going to be severely impacted, and it will be very interesting to see how this offset data accounts for that, because again, the data set doesn't go back. APRA and the RBA has no long-term history to understand what happened after the GFC or other periods where rates go up, and so again, I think this is, while there is some comfort in the short term, I think these numbers are going to change very dramatically adversely against households over the next few months.
And it's just worth underscoring, isn't it, John, that the total debt burden increased, the total buffers increased, but some of that increase was simply because the debt's gone up as well, right? So the relative proportions didn't move that much. And it's about 120 billion, if I add those two numbers together, I think is the total buffers, right? Which, by the way, is a lot lower than the 250 billion that were being quoted previously.
Yes. So I'm glad you made that point. So what we can tell is that between additional extra repayments on the mortgage, but also in terms of additional money in the offset account, we're talking roughly around $90 to $100 billion extra, and that is less than the $250 billion. So if there are $250 billion of extra savings, a lot of those extra savings were made by households that don't have a mortgage.
And go back to my point, some of that will be the rise in equity values that happened through that period, right? So it's wealth, but it's not necessarily accessible wealth. And by the way, now stock markets have been correcting considerably, so that value might be a lot lower now. We need real-time data, not 6 months, 12 months, 18 months, 2-year-old data.
Exactly. So to bring this show to a conclusion, Martin, if there is anyone out there who is placing their financial future in the hands of politicians, but also these economic officials, and say the governor knows what he's doing, he's got a PhD from a prestigious university, he's been in the job for a long time, people respect him because he's apparently, he knows what he's doing. What I've learned in the last 2 weeks by being annoying to the RBA is they don't know exactly what they're doing because they don't have real-time disaggregated cash flow data like you do. And so they are flying blind. That's why the title of the show is "The Living God." That is in terms of deaf, dumb, and blind, because they pretend they're all knowing. They pretend that they know what they're doing, but once you start to press them for specific information about their data and their processes, you start to realize that it's not what it is cracked up to be. And that for households that are in a difficult financial position today, but also in the months ahead, this is a disaster waiting to happen.
I agree, John. And it's a very important message. Thanks for that research and for talking about this today, because it's something which I've been talking about for a long, long time. It's concerned me greatly, and I'm afraid that we're going to see how this plays out in the months ahead.
Absolutely.
Martin North, John Adams, in the interest of the people. We'll see you next time.